Hey everyone, Kyle here with another Tax Talk Tuesday topic. Tax Talk Tuesday topic. Alliteration is great. This week, I wanted to shift away from all the income tax things that we've been talking about and instead touch generally on something known as estate and gift taxes. In case you didn't know, NC planning focuses on, well, all things legal planning, and estate planning is a large part of what we do. You may think of estate planning as just wills or powers of attorney, but there's so much more involved in this than just those standalone documents. So among other things, a solid estate plan should really take taxes into consideration when they're being put together. And, we get a lot of income tax related questions when we're setting up estate plans, especially when we're setting up a trust, a revocable living trust. But individuals have to be aware of another set of taxes, especially high net worth individuals, and that's what's known as the Unified Estate and Gift Tax. So a little bit about this. For tax year 2020, the estate and gift tax exemption amount has been raised to $11.58 million. Sounds like a lot. It is a lot. But what this means is that an individual can give away, either during their lifetime or at their passing, a total of $11,580,000 without paying an estate or gift tax on that amount, at least not at the federal level. And if you're in North Carolina, there is no state level estate tax, at least not anymore. Married couples get to double that 11.58 to $23.16 million through something known as portability, but we're not going to talk too much about that right now. Suffice it to say that generally married couples get to double the estate tax exemption amount. So all this together, what it means, any lifetime or post-mortem gift that exceeds the 11.58 or $23.16 million mark is going to be taxed at 40%. That is the estate tax, or gift tax if you happen to exceed that during your lifetime. So using rough math, let's say we have a $15 million estate. That $15 million estate is potentially going to pay estate taxes of a little more than $1.3 million straight to the government. That's huge. And remember, guys, that a lot of people who have $15 million estates, which sounds like a really good problem to have, don't necessarily have $15 million in cash or even in semi-liquid assets. A lot of times, and all too often, it's a family farm or other family land. Maybe it's in a high growth area and the tax basis in it is really low. Or maybe it's ownership in a lucrative or long-standing family business. That ultimately either one of those assets may have to be sold to satisfy an estate tax burden. Those are things that we want to avoid. And so with tax bills in this arena being so high, strategies in this area abound. Complex trusts use some discounting formulas, insurance policies get purchased to satisfy tax burdens, and even some people set up charitable strategies just so that charity benefits from their wealth as opposed to the government. But the strategy that I wanted to focus on today is almost the all too obvious one. Implement a family or a family and friends gifting strategy, taking applications to be considered one of the friends there. But what does that mean? It's really simple. Currently, the IRS allows you to give up to $15,000 to any person, gift tax free. This means that the individual $15,000 gift that you're making does not eat into that $11.58 million, or whatever that number might be at the time. And married couples can double that and give up to $30,000 to an individual. Or married couples can give up to $60,000 to another married couple. All of that gift tax free, and so on and so forth. It can build and compound, and those are important strategies to use. And if you need to use a more aggressive gifting strategy, you can start eating into that $11.58 million number. Because quite frankly, there's no guarantee that those numbers are going to stay the same. Right now, what the IRS has decided to do is that in 2019 they issued final regulations, and what that means is they have set this rule in place that if you make a taxable gift, otherwise taxable gift, that would eat into that exemption amount, while the exemption is $11.58 million. Say you've gifted away $6 million, and the exemption amount years from now resets to something much lower, like $5 million. They're not going to look at that $5 million and see that you gifted away the $6 million and say, oh, well, we got to collect taxes on at least $1 million worth of assets there. They're not going to do that. They're going to look back at what the exemption amount was at the time that the gift was made, so that 11.58, if you made it this year, it's going to be potentially higher next year. It gets really complex there. What I'm trying to say is that gifts made during your lifetime while this exemption amount is higher, as long as it's not exceeding the gift tax amount right now, those are going to get locked in and remain below the exemption amount. So again, if you need to utilize a more aggressive gifting strategy, this is where you really want to talk to an attorney, a CPA, your team, to determine what the right thing to do is. But bottom line, if your estate exceeds the exemption amount, or you believe that it will in the future, a routine gifting strategy sounds like a simple strategy, but it can substantially reduce your estate tax bill year over year. So if you need help deciding what assets to give, we can help with that. Really, it's as simple as that. Finding assets that it makes sense to get out of your estate so that the estate tax burden isn't there. And this is a great tool because you get to give gifts that potentially put grandchildren through college, or help pay off medical debts of another family member. And in the end, it's saving you money when the estate tax exemption amount is exceeded. As always, guys, thank you for watching. We hope we see you next time. Feel free to subscribe to the channel, and thanks again for watching.